You've got the debate around the health of the banks in China. That's heated up again after UBS warned that many have managed to sidestep the severest curbs on their shadow banking activity, suggesting the real pain of the deleveraging process is still ahead. Hartmut Issel, he's the head of APAC Equity and Credit at UBS Wealth Management, is still with us from our Hong Kong studio. Let's kick off with this piece by UBS. They're describing extensive use of a short-term funding instrument called negotiable certificates of deposit that are clouding the real extent, the real scale of the shadow banking problem in China. Would you agree with this view, Hartmut?
But to me, it seems that the authorities in the deleveraging process are tackling this sort of off-balance sheet market step by step. And yes, we see also idiosyncratically, as I would expect, right, some corporates also in financial difficulties. This is part of the process, but yeah, looks quite idiosyncratic at this point. So yes, it has a bit of a drawdown effect on growth, but we think it's going to be a relatively mild one. But if you think about it from an investor's point of view, these things happen mostly outside the listed banks, or really where the growth slows down, and also wealth products, for example. This is where it slows. So we're actually seeing that, especially for the large banks, some of that business is coming back, and they can. So it's a volume a booster, if you will. And the margins also coming back because they are in a better position to demand better lending rates. So for the for an equity investor in the broader Chinese market, that is not an uninteresting development. Quite to the contrary, that for the big banks, the listed ones, it actually helps.
Where does that leave your wider view for Asian equities in light of generally rising U.S. Treasury yields? Obviously, that is currently on hold. But again, the theme is one where emerging markets are at risk. What are your top plays in Asia, and where do you see U.S. 10-year yield going?
Yeah. We have the U.S. 10-year in our estimate in about 12 months' time at 3%. So we don't think the long end has that much more to go. Of course, the short end more. We expect 3 more hikes this year, and then followed by 3 hikes next year. So yes, the curve is to some extent flattening. Now, coming to Asia. Yes, Asia is a later cyclical market that should also help or support at least the outperformance. One of the interesting ideas we have lately written about is especially mid-caps in the Asian markets.
What about being a bull in any of these fixed income markets? I mean, it's hard to make a case for bonds at the moment. At this stage of the cycle, is that something you subscribe to?
Well, some areas we still think look better than others. So, for example, in emerging markets, the sovereign dollar debt, for example, looks interesting. We're also showing to the investors the so-called senior loans. So at this part of the cycle, when you're not actually just ahead of a recession, so that the cycle has longer to run for at least the next 12, if not 18 months, floating instruments, so such as the senior loans. Also, by the way, they have already done fairly well. They should continue to do relatively well during this year. But yeah, one has to certainly become more selective in the fixed income space.